Welcome back, ladies and gentlemen. Tonight, the US banking crisis seems to have been narrowly diverted. Is this a permanent solution, or will there be further pain on down the road? Let's check it out. As you may or may not know, on Friday, Silicon Valley Bank, a quite large sort of tech-related bank based in California, collapsed after trying to sell bonds to cover some cash flow. These bonds sold at a loss. A rumor campaign was started, and depositors started pulling money out like crazy. Something like $42 billion in deposits went in one day, if I recall correctly. This resulted in Silicon Valley Bank being shuttered at the end of Friday closing, and the weekend was full of all kinds of weird speculation. Due to Silicon Valley's Bank's sort of proximity to tech and crypto generally, there were a lot of weird dislocations in the crypto market, the most notable being the depegging of Circle. As you can see from this rather impressive looking chart, USDC, a very, very large stablecoin run by Circle, briefly depegged down to 87 cents. Now, stablecoins, of course, are meant to track the US dollar one-on-one, and although there was a certain amount of panic over the weekend, USDC seems to have recovered, and the crypto space is actually doing very well at the moment. Bitcoin is up massively. So what happened? Was this all just a sort of fart in the wind, or will there be other implications down the road? Well, it looks like what basically happened was that there was a stealth bailout. This was the bailout that is not really a bailout, and it's quite complicated. The Federal Reserve of the US is in a bit of a difficult position at the moment. Under Trump, they were put under the congressional debt ceiling limit, which means that the Fed cannot just print more money and enable quantitative easing the way that they used to. They've got to be a bit more tricky about it. But what was the real cause, ladies and gentlemen? Well, what started this whole thing off? Well, all this really comes down to the measures that the US took to stop inflation, which was to raise their baseline interest rate from basically 0.5% in May 1st last year, all the way up to nearly 5% now, which has had an incredible knock-on effect in the financial industry and spilled over into the rest of the economy. As the interest rate goes up, bonds devalue. It becomes more expensive to loan money. Any variable rate thing that is tied to interest suddenly gets more expensive, and generally economic activity slackens off. This is the big dirty secret that they don't really tell people when they start jacking the interest rate. They know it is going to produce more pain. They know it is going to induce more unemployment. They just don't put it that way. Instead, they frame it as, we have to get inflation under control. Of course, inflation would be under control if it were not for the way that the system is originally designed, where, for example, the Fed and all the other central banks around the Western world printed literally billions and billions of dollars out of thin air during COVID, and the bill has now come due. Now, the reason why all this is coming due at the moment is directly tied to the Fed interest rate. Essentially, for the layman, bonds are generally fixed interest rate at the time that you buy them. A bond is essentially like a kind of loan you get from the government. You give them money, they give you a certain amount of money every month or every 6 months or every year, known as the coupon. The amount that they give you is the interest rate on the value of the bond. As the interest rate goes up, suddenly you have a situation where people could get basically better interest by buying newer bonds. And a whole bunch of these like old bonds valued at 0.5%, 2% are lying around on bank balance sheets, basically waiting to have their losses realized, at which point the banks have to declare, oh yes, these bonds that we have, they're not worth very much on the market at the moment, and we're going to take a loss on them. Fortunately, or unfortunately, due to a bunch of new accounting tricks brought in after 2008, it's very, very easy for banks to hide these losses, and there is a massive hangover waiting to bite. However, the Fed, as always, has the back of the banks, and they have decided to do a sort of bailout light, as it were. This bailout light, unlike the bailout in 2008, where money was directly printed to buy bonds from these failing banks, will basically say that the Fed will lend them money. I believe the length is for exactly a year. So this whole thing is going to blow up again just before the next US election, which presumably will give a whole bunch of confusing cover and make the entire thing a lot more fractious than it would usually be. Essentially, the Fed has said that they will loan money to these banks, but the amount that they will give them is based upon the face value of the bonds, not the actual value. So it's a bit like this, right? I bought, a thing for $100, right? And it says on the thing, it's a $100 thing, right? But there's been so many of them and things have changed in the intervening years. And now no one is going to buy my $100 thing for $100, despite the fact that it clearly says $100 on it. I own millions of these things, and I don't want to tell all the people that are investing in my company, all those things that we've got that's got $100 printed on them, they're actually only worth $60, because people might be like, well, why the hell are we giving you our money if you're basically insolvent? But what if the Fed was like, hey, buddy, look, relax. How about we figure out a situation whereby I will loan you the money as though these $100 things were still worth $100 and not $60. And then hopefully with all of this extra money, maybe the price of your $100 things will go up, or maybe you can sell them on the down low, or maybe you can just tell everyone they're worth $60. But because you've got a line of credit from the Fed, everyone's going to be like, oh, it's okay, I can leave my money in there. And this, of course, is the big problem, essentially, with fractional reserve banking from the point of the view of you and I, the citizen. The banks never have enough money to cover their deposits. In fact, in 2020, the US Fed actually slashed reserve requirements to zero. Reserves are the amount of money that a bank has to keep on hand in order to cover for bank runs. So if a whole bunch of people come in and say, hey, we want our money back, the bank has some money back. It's money in there, in cash. It's not all out in investments, in derivatives, and all this kind of other stuff. There is actually cash there that they can give you. However, not anymore. And of course, this is the big problem with the system as it is currently constituted. The other problem, or the other upshot, in crypto circles anyway, is what has been happening to the banks that were linked to Silicon Valley. Another bank called Signature was the other large crypto-facing bank in the US. And it now seems that the ability to get your money in and out of crypto has been massively dented. All the large banks are basically saying, oh, look, we don't want to deal with crypto anymore. So it's very, very hard to get your money from those banks into crypto or out of crypto into those banks. Signature and SVB were two banks that were basically fulfilling that function, acting as bridges between the normal market and the crypto market. Now, of course, the powers that be have not liked crypto from its inception for a whole bunch of reasons. They say it's due to monetary destabilization and all this kind of other stuff. And yes, there is a component of that, as anyone who has been burned buying a shitcoin will realize, but it's also more than that. Effectively, the government does not want money that they cannot control. They can't control the interest rate on something like Bitcoin. There is no interest rate on Bitcoin. They cannot control the issuance and destruction of Bitcoin. They can't print it out of thin air, and they don't like it, ladies and gentlemen. No, they don't. In the Fed's universe, in the universe of the government, money is something that they create and extinguish at certain times in order to support certain agendas. Indeed, one of the main problems that a lot of the lefties have with capitalism, as it were, is not really capitalism per se. It's more sort of, I guess like a huge sort of banking scam where money is sort of leaked out into the economy and then sucked back in this sort of like weird boom and bust cycle, which ensures that people in the know always get the right tips and are never in danger, and they can make an incredible amount of money coming and going. Instruments like Bitcoin, actual safe cryptocurrencies completely break this model because they cannot issue it whenever they want. They also cannot destroy it whenever they want. And so the way they would put it is that it is resistant to monetary policy. So is this going to be the end of the banking crisis? Well, that's really the curious question. Nobody knows. Markets are just about closing in the US, and it seems that there has not been a massive downturn, a catastrophic downturn, as it were. Although there have been a number of banks hit very, very hard. Most of them are small regional banks. It doesn't seem like there have been any large banks terribly affected. G-SIFIs, or we call them in the trade, globally significant financial institutions. The kind of institutions that if they collapsed, entire countries would go under. At the moment, the damage is pretty limited. And with the news of the bailout, all kinds of funds went up. Bitcoin shot through the roof. Everybody was happy. There's a bailout. However, if any of you are old enough to remember 2008, this is the way it played out in 2008 as well. 2008 started in March, on the 16th, I believe. So nearly to the day. And there was like a bailout and everything was good up until May, when basically everyone who was in the know pulled their money out of the system. What's going to happen? Oh, I don't know. I can't wait. I can't wait, bros. It's going to be like so awesome. The next financial crash. I am just absolutely glad that there's no one waiting in the wings, with a plan of a central bank digital currency. And there's not going to be any people who would be massively galvanized and benefited by a crisis of this magnitude. There are also rumors circulating, for example, that a buyer for Silicon Valley Bank was in fact found, but the Fed didn't let it go through for reasons. And also that Signature Bank was not in fact insolvent, but was shut down because the Fed don't like crypto banks. We will wait with bated breath to see whether this is true. And we will also wait to see whether this party leads to an even greater hangover. If you got to the end of the video and you like this, thank you very, very much. We'll see you in a couple of days. Please like, share, and subscribe and all that good stuff. We have a live stream on Thursday night at 8 p.m. London time. Hope to see you there. Good night.